What's Your Work Fit is sponsored by Hudson Davis. Start your brand's marketing and communications journey today at hudsondaviscommunications.com. I'm Dan Smolin. I built a successful executive career in marketing and communications before becoming a top headhunter and founding my own executive search firm. Now get this, every day, mainstream media runs stories in which old school bosses and thought leaders frame your work and workplace issues in ways that are often divisive and unmeaningful. And that's just crazy. The time has come for you to answer the question, what's your work fit? So that your work and career fit who you are, how you want to live, and what you want your lasting contributions to be. What's your work fit? It answers your questions and tackles the issues that keep you up at night about advancing your career in this time of workplace revolution. So let's get started. Hey, good day, everyone. Dan Smolin here from What's Your Work Fit, and from today's What's Your Work Fit in the Workplace series show. It's a live show, and on behalf of everyone here, I want to thank our audience for helping us to get the word out about What's Your Work Fit. We cannot do this show without you. So we appreciate your loyalty, your support. If you haven't done so already, I'm asking you to join up with us on the platform of your choice. We're on LinkedIn. You can go to our What's Your Work Fit LinkedIn page and hit the magic button, and you won't miss any upcoming events or notices. You can do the same on Facebook Live, and of course on our What's Your Work Fit YouTube page. You can subscribe there with the big black oval button. Okay. Happy Valentine's Day to everyone out there and the women in my life. My mom, Reva, who turned 94 last week. My wife, Marcia, who I will be married to 40 years in November. And last but not least, my daughter, Darren, who's down in Richmond. I love all of you. Our co-host friend, Saley, wanted me to bring flowers today. But, you know, the problem with flowers is, especially roses, is after a week they die. But why not a box of chocolates? They never go bad. They give lots of love. Very quickly, they outgrow this box. I hope everybody out there is having a wonderful Valentine's Day. And may it bring you lots of joy and love in the year ahead. Okay, I am so excited about our show today. I'm going to introduce our guest. His name is Phil Mobley. Hi, Phil. How are you?
Hi, Dan. I'm doing okay.
Going to do a little
in the air, it sounds like.
Yeah, it is. Phil comes to us from Boston. I'm going to tell you a little bit about Phil. Phil is the National Director for Office Analytics at CoStar Group, which is the leading provider of commercial real estate information, analytics, and online marketplaces. Sounds like a great gig.
It's a lot of fun, especially now. There's just so much going on in the sector. It's so dynamic. So yeah, I enjoy it a lot.
Well, I'm going to bring in our co-host now. First off, welcome Mark Gilbreth. Hi, Mark.
Good morning, Dan. Hey, Phil. Good to have you with us today.
Mark
Thanks.
I'm sorry, I didn't mean to step on you. Mark is, of course, the founder and skipper of Liquid Space. And also we want to bring in our other co-host, Fran Saley. Hey, Fran.
Hey, Dan. How are you? And hi, Phil. Great to be with you today.
If you haven't seen Fran's posts on LinkedIn, they are a must-read always. He is the leading thought leader in future of work and workplace, and he would love to have you follow him.
Well, I wouldn't go that far, but
okay.
A lot of good people out there.
So. A lot of good people out there. Okay, gentlemen. Phil, let's get to this lead question, which the three of us have for you, which is, what happens to office leases in 2024? Let's get started. What are your thoughts on this?
Sure. Well, I'll give you the short answer. And then I think there's a longer answer. So the short answer is I think what happens in 24 is the same thing that happens in 23.
Mhm.
But to kind of justify that, why don't we go to the first slide, and I'll kind of give some background on why that's our point of view at CoStar. So the first thing that I like to sort of point out is that this time really is different. If you look at the three major office recessions of this millennium, on the left in the blue there, you've got the dot-com crash in 2000, 2001. And so what we're displaying here is what we call negative absorption. So absorption is just move-ins minus move-outs. It's the change in occupancy over a given period of time. And so in the 5 quarters or so that absorption was negative in the dot-com crash, cumulatively, we lost about 75 odd million square feet of office occupancy.
Wow.
Yeah. And then in the Great Recession, which lasted a quarter longer, we didn't lose quite as much. We lost about 50. But then in the 4 years, so it's almost 4 complete years since March of 2020 when the pandemic hit. So we're 200 million. So it really is different. It's different in magnitude, and it's also different in character. So the thing about those first two, the dot-com crash and then the Great Recession, is that absorption, so occupancy, actually started increasing again before all the jobs came back. Job growth became less negative, and already companies started taking on more space. Well, that hasn't happened this time. We're actually back on employment trend, well above the level we were before, 2.5 million office using workers lost their job in 6 weeks in 2020. But all those jobs plus some are back. And so if you go to the next slide, I'll show you kind of what that looks like. If you look on the left here, so the blue is if we had started at the end of 2019 and employment had kept growing at the same rate for the last 4 years. The blue shows where we would expect to be, and the red shows where we actually are on the left side. So we're right where we would have expected to be, about 1.5% a year, 6% above the number of jobs that we had in 2019. On the right is occupancy. So occupancy in the 2010s had been growing about half the rate of employment, which is interesting. It means we were already densifying. We were using less space per worker. So employment was growing faster than occupancy, but it was still growing. They were growing together. Well, now we've actually cumulatively lost, 2.5% of inventory. And we would have expected to have gained that much. So in square footage terms, we've lost that 200 million, which is, for a frame of reference, a little bigger than the entire office inventory of San Francisco.
Oh my gosh.
Depending on your assumptions, if you take that plus what we expect that we should have gained, or under air quote normal circumstances, you can more or less double that. So then you're talking about something that looks more like Los Angeles.
Wow.
So this is different in both magnitude and in quality, I think, than what we've seen certainly in the last 20, 25 years. So then to really get into the answer to your question, what's going to happen with leasing? So the next slide shows what has happened over the past 10 years or so. So this is a little complicated because I love me a good line chart, but the blue line here is total leasing volume. And that's, we calculate that in square feet, but I've got that indexed to the end of 2014. And then the red line is the number of lease transactions, and then the yellow line is the average size. So if you follow the blue line first, then what you see is that in 2020, volume plummeted. That makes sense. It recovered in 21, 22, and then in 23, it fell off again. And it ended up kind of, around 12% below that long run average, or about where it was in 24. Interestingly, the number of lease transactions is actually higher than that long run average. A little lower maybe than 2016 or 17, but above what it was in 2019. And so if the number of transactions is going up, but the total amount of space lease is going down, what that means is that companies are taking on smaller space commitments. And so that's the yellow line, which is the average size per lease, which is about 20% below what it was in 2014. So that was really consistent really, if you go all the way back to like Q4 of 22,
Mm-hmm.
we had this consistent pattern of a lot of tenants in the market, but their space requirements were smaller. And so that brought the average size down, which in turn brought volume down. That was consistent all last year. And we expect that to continue for a couple reasons. One is that we're about halfway through the churning of the leases executed before 2020. So we've got, high 40% of those left, about half of which are rolling or set to roll in the next couple years. So we think that, companies are sort of responding to the market conditions as they currently exist. And we think they will continue to do that. And if you go to the next slide, there's a tell, right? And it's like a poker game. The tell is that the tenants have already put twice as much inventory on the sublease market as was there on the end of 2019. So it looks like that has peaked. It actually came down a little toward the end of last year, but we're still at 2x what we were, 200 plus million square feet available for sublease, a lot of which is already vacant. So, this is the canary in the coal mine that a lot of these tenants we think are going to continue doing what tenants did in 23, which is to reduce their space commitments. Now, this isn't going to happen evenly. It hasn't been happening evenly. So if you go forward one more, Dan, the first at the market level on the horizontal axis, so the further to the right a market is on this chart, then the more exposed they are to the information sector. And the information sector is the government Bureau of Labor Statistics category, where most of the big tech companies, Microsoft and Meta and CoStar, we're all information sector companies. So more exposure to the technology sector means more negative absorption, more occupancy loss. And this is just in the last year. So this is not cumulative, but just so San Francisco last year lost 5% of its inventory and occupancy, which is it's staggering.
It is
really
staggering.
is. And you can see that they're an outlier, but the trend is there. And another way that this is not happening evenly is, there really is something to the downtown versus suburban. So if you go one more forward, I'll kind of illustrate that.
Okay.
So back to cumulative occupancy losses now. So downtown CBD, central business districts, have lost about 5% of office occupancy since the beginning of Q2 2020. And then, so we actually split this up three ways. So urban would be other urbanized areas that are not quite downtown. So think about a lot of New Jersey or Brooklyn or something like that. You can't really call it suburban, but it's also not downtown Manhattan. So downtown and urban each are about 25% of inventory. And so the downtown's done worse, followed by urban. And then the other half of office inventory is suburban. So in absolute terms, the occupancy losses in the suburbs have been almost as big as everywhere else. But in relative terms, it's only about 1% of inventory. Only about 1%. I mean, that's catastrophic in any other office downturn. But, the suburbs have performed, I guess, less poorly. And then finally, in terms of how this is playing out, and we think will continue to play out, is there's been a lot of ink spilled about this notion of flight to quality. And I think that in the way that we traditionally think of quality, that's actually not true. If you define quality in a somewhat different way, then I think it is true. So the color codes you see here, the blue is what we call at CoStar 1 and 2 star. So this would be kind of like your class C and below level properties. We use a star rating system that's intended to be kind of location agnostic and remove some of those connotations. But and then the red bars are the 3 star, which is like your B minus. And then 4 star, A to B plus, and then 5 stars, like 6 or 7% of inventory at the top. That's your trophy, right? And interestingly, if you look at when buildings were constructed, when they were delivered, so anything that was delivered before 2020, regardless of its quality rating, whether it's a trophy product or whether it's a class C product, they've all lost occupancy. But if it's been newly constructed, so built since 2020, then they've all gained occupancy. And this is, it's lease up, right? It's tenants moving in upon completion of the building. And that 15%, positive absorption looks pretty good, but that's about half what we would normally have seen. So even in these new spaces, they are getting filled up, but it's taking longer than historically it would have. So if you define quality as new, then sort of regardless of the level of that quality, then new is certainly performing better. But if you define quality as in a more traditional sense of, amenities and location and whatnot, then we haven't really seen what you would traditionally think of as a flight to quality. So there's a lot of nuance in the way this is playing out. But I think the short answer to your opening question is we expect more of the same, with maybe a large number of leases, or a comparable to normal number of leases, but tenants in general taking on less space, committing to less.
So for our audience, I just want to say you may have had a little bit of difficulty reading the charts on your screen. And what we're going to do is provide in the show notes for this live show a PDF of Phil's entire presentation so that you can look at it and perhaps even follow along with a replay of this live show. Really phenomenal deck there, Phil. I want to continue the questioning with Mark. What do you got?
Thanks, Dan. Phil, CRE leaders, corporate real estate leaders, are under enormous pressure. We see a lot of ink spilt around that as well, to consider, cost rationalizations in their portfolios. And a lot of the conversations we're hearing in the market are that, some are advocating for, aggressive downsizing to achieve those cost reduction, goals set by their CFOs and CEOs, while others are hesitating and pausing, fearing that, by cutting back on that portfolio too much, they might disrupt productivity, or they might erode the culture. Given CoStar's sort of lens into market data, unrivaled, what hot take or insight can you offer to help those leaders, those CRE leaders, with their sort of finger on the lease renewal decision, to help them navigate the uncertainty of the moment and make, more informed decisions that, balance cost savings versus, culture or future proofing of their portfolio for possible recovery in attendance? What's the hot take you might offer up on that front?
Yeah. So, what I would say is, if you think back to that trend that we used to call densification, a term doesn't make sense anymore, because offices don't necessarily feel dense. But we used to call densification, meaning we were occupying less space per worker. And that was a trend that was consistent throughout the 2010s. And then it was de facto accelerated when, a lot of companies did and have trimmed their footprints in the last 4 years. So you asked for a hot take. Here it is. I think this behavior we're seeing in the leasing market now actually has more to do with that trend than it does with hybrid per se. Now, that's not to say that what we're seeing with changing workplace arrangements is not a crucial factor, because it clearly is the crucial factor. But what seems to be happening is, if you had asked a workplace consultant or architect in 2018 to come look at your space and evaluate it and your efficiency, whatnot, they would have told you, I can save you conservatively 15 to 20% and aggressively 40%. Right. And that was before everyone was paying attention to, attendance, utilization, what have you. Well, now everyone's paying attention to that, right? And so those tech companies that were growing 20% a year in 2017 and took on 10 floors in a trophy tower in San Francisco, filled 7 of them and said, we're going to grow into these other 3. By the way, those were the most expensive rates ever, right? Certainly on an effective basis. Well, guess where a lot of that space is now? It's in that sublease figure. So I think the reality is that a lot of organizations were inefficient with their space use before 2020. And now, when the leases come up for space that they haven't been using, certainly not fully, then yeah, they're going to cut it back. They're going to give up buildings and consolidate. They're going to reduce from 7 floors to 5. What seems to be happening is smaller companies are, rather than renewing like they maybe traditionally would have, they're picking up and moving to a nicer building, and they may take the same or even slightly more space, but it's not really a positive occupancy event for the market. It's kind of a normal or even negative, certainly for the one they left. So this focus on being efficient, because we are seeing some more layoffs, but by and large, companies are hanging on. Certainly over the last year, the information sector, the tech companies are largely flat since kind of May of last year. The other major office using sectors are nominally positive. So we haven't seen massive layoffs. It looks like companies are preferring to try to hold on to their talent that they worked hard to recruit in the last 3-4 years. And looking at real estate as one of those cost-cutting opportunities.
Thanks, Phil.
So we're going to get to Fran in a second. I wanted to ask you about the aversion to renewing a leasehold and maybe going elsewhere. Is it sort of like the trick with credit cards where you make it a low introductory rate from another trade line rather than stay with what you got? Phil?
I think that's part of it. There's a couple things going on with that preference for new space that I alluded to earlier.
Mm-hmm.
One is that there is a belief in the market, in the occupier market, that to attract and retain talent, and certainly if I want them physically present together for collaboration, then what I need is the best space that's, it's got all the LEED certifications, it's got the amenities, it's got the transit access, it's well located, it's in the hip part of town. So that is definitely at play. And I think what's also at play that's not disconnected from that is when you move into newly built space, you'll typically get some funding from the landlord to help build it out, especially now. So we've actually seen a phenomenon over the last 4 years where the face rents, the asking rents, have largely held flat. They dipped a little in 2020 and then kind of came back up, but they're about where they were at the end of 2019. But what's happened is the value of lease concessions, which is either a period of free rent and or an allowance to build out the space, the value of those has gone way up. So you might think in 2018 you'd get 20, depending on the market, 20% of the value of the lease in concessions. Well, now 30, 35, maybe. There's a lot of variability there, obviously. But, that is attractive to tenants when they're thinking about, okay, my office is now something that I need to use efficiently and effectively. It's got to engage my workers. It's got to attract them. I don't really have a stance on whether that's all true, but it's definitely true that it's a belief in the market that's being acted on. So I think that's one of the dynamics that we're seeing with this: less likelihood to renew in place and greater likelihood to seek out something that we think is going to work better.
Fran?
Thanks, Dan. Phil, this is actually, I had a question, my first question written down, but I sort of changed it into a two-part question. And this is, I just want to get your opinion about what is very commonly discussed in the business today as occupancy and the measures of occupancy. We've all seen the castle stuff, and there are some similar measures that have trended to show, or said they've been similar, but they've been showing occupancy at about 50% roughly of the leased space. And we know that a lot of that is determined by badge data, sometimes one way, sometimes two way. But you can come in, badge in, have a cup of coffee and leave. It doesn't mean very much. There are some firms that have sensors distributed and are able to get very granular in the actual utilization of the space. And if you look at their numbers, which I presume are a little more accurate, in terms of how much is actually being used, it's much smaller than that. Somewhere in the 25% range or less for some occupiers. So, and this goes to the heart of the real question I was going to ask, which is, we see the Sam Zells of 2024 out now trying to steal buildings at 50% of their old value.
God bless his soul.
Value. And they're assuming that, this cycle is going to be a little longer, a little deeper, but it's going to come back. But there are some that say we really can't see the bottom yet. So, two-part question there. What's your sense of the occupancy data, and is it meaningful to you? And what, I assume you don't track that stuff for a number of reasons. But what should occupiers think about occupancy today? And the second question, how does that relate to the valuation situation and the floor of values in this cycle, which, as you said earlier, is different than any other cycle you've been involved in?
Good question, Fran.
Yeah. So first, a clarification. I'm very glad you asked this question. I've been using the term occupancy in a very strict sense, which is, the CoStar sense, which is that we consider space occupied if it is physically controlled by the tenant or perhaps the owner who uses the space. Whether or not there are any physical humans in the space, it's occupied if the organization has control of the space.
Interesting.
The what's commonly called occupancy or physical occupancy, we use the term attendance for that, which has some imprecision of its own. Utilization is another term that you'll hear, which is really more, as you alluded to, about how efficiently individual spaces within a suite might be being used. But okay, let's talk about attendance. There are various measures of that, or at least proxy measures. One is transit data. And if you look at transit data, there's a site called APTA that I've been looking at. And we don't at CoStar have a proprietary measure of any of these things. So we look elsewhere at kind of what sources are available to help inform our analysis. But transit data, if you look at it kind of nationally, is in the 70% range compared to 2018, 2019. Now, of course, not everyone who rides transit is an office worker, right?
Right.
There are plenty, especially in big cities, plenty of service sector workers who are riding public transit. I see some of them every day coming into Boston. So I think it's a good directional measure, perhaps not a good absolute measure. And then you get technology like the Castle Systems access control, and there are some others that do similar things, which I think is a much better measure of who is entering the buildings where those products are installed. But you do have to consider that, and Castle, by their own admission, will say, look, we're not representative of the entire office market. We have a 10-city index, and it's reporting on buildings where our product is installed, and they're very upfront about that, and I respect that. Again, I think directionally it's quite interesting, and I think just today they reported last week's figure at 51.8, which was down slightly. I think it hit 53 last week, which was the highest. The other thing that's interesting and important about that is that you got to think about what the reference point is. So the reference point is whatever February 2020 was, we're going to call that 100, right? When in reality, you probably had 60, 65% of seats filled on any given day, if that. So, 50% of 65% is what, 37? Less than that, 33. So yeah, that I think that's just important for calibrating. And then you have things like Nick Bloom's survey, Gallup has a survey that they do. So there are other ways of sort of estimating, what's the frequency of attendance. But I think the reality is they're all showing something plus or minus 60-ish%. Maybe add 10 points to that on Wednesday and take 10 or 15 away on Friday. And they've all been really flat over the past year plus. So that's one of the things that we take into account when we're forecasting, right? But we don't see a high likelihood of a dramatic increase in attendance. I do think it will continue to tick upwards, but it's not going to 95% by June of what it was in 2019. So that's part of our outlook as well. And then, so to your question about values,
and demand, really, it's demand driving the value, I think.
It is. So we have a value estimation series with a forecast, and it shows average values down about 13% from peak and going down another until they get to about 30, which would be comparable to what we saw in the Great Recession. But of course, there's no such thing as the average office building, right?
Mm-hmm.
So if you were to buy a long-term single tenant net lease office building in a secondary market where the tenants there, their employees are using the space, it's going to have a value decline from 2021 just because of what's happened with interest rates, presumably, unless you have an all-cash buyer come in or something. But it's not going to have the same sort of structural valuation issue that commodity class A, middle-sized Manhattan office tower multi-tenant is going to have, because you have not only lower occupancy typically in those buildings, but you have more uncertain future occupancy. Who knows how long that space is going to sit vacant. So we've seen buildings trading at, in San Francisco especially, 40, 50, 60% discounts to some of their valuations around 2015. And the interesting thing about that is many of the buyers who are active in the market for that kind of deal, and think, below the sort of $100 million deal, but there are private buyers who are writing checks for $20-30 million, right? So they're low or no leverage. They're coming in and they're getting these values at steep discounts to their previous valuations at what looks like really low, below replacement cost price per square foot. The reality is those buyers, they can sit there at 50% occupancy if they've got a lot of term left on the lease, and they can cash flow that property.
Right.
And so yeah, it's like, on the one hand, that's bad for values of other buildings in the market. I believe it's going to help bring them down and help them reset when more liquidity returns. But on the other hand, some of these opportunistic private investors are probably going to be just fine, at least for a little while. And they are betting, to your point, if things really do come back, well, then it's just all upside for them, right? They fill up the building and then sell it at, let's say it recovers even halfway in 5 years, sell it for 50-70% more than they paid for it, maybe more. So yeah, it's a really interesting time for values, and you've got to think about things deal by deal.
Got it.
So want to get to some questions. The wonderful Sophie Wade chimes in and she says, I'd love to hear your thoughts about the signals coming from the market anticipating loan defaults. What are your thoughts?
Yeah. So, interestingly and happily for me, I was looking at this just early today, and our data show that we've got about $50 billion in CMBS maturities coming up by the end of 25. Now, CMBS is a relatively small slice of the market, but I think it's generally indicative. It is a lot of those kind of major market, central business district, multi-tenanted buildings. So it's kind of, I think, what a lot of us have in mind when we think office building. The delinquency rate has certainly gone up. It was 8%, maybe 7.5% or so as of January. It's coming up into the 8s now, which is now higher than it was right in the throes of the early part of the pandemic. So I think that's an indicator. As those loans mature, not just CMBS, but as loans mature, that's where you're triggering liquidity events, right? But at the same time, we have, I think, a lot more of those that are being extended than perhaps we anticipated 6 to 9 months ago. Some for contractual reasons. A lot of the short-term CMBS loans originated in 21, 22 had those provisions in them. And some for workout reasons. If you do have reasonably stable occupancy and the tenant's paying and you can make your debt service or get close to it, even if the LTV is a little bit off, there's a lot of that kind of workout behavior happening. So I don't think it's going to be, the wall of maturity that triggers this immediate price crash. I do think that it is a factor that's going to help liquidity improve and then reset prices over the next, I think we're calling the trough right now around the end of 25. So over the next, 20 months or so.
Mark?
New question direction, if we could, Phil. With many large employers unsure about the long-term space needs for their workforce, beyond a few quarters even, is the increasing popularity of flexible office and co-working solutions simply a short-term response to this current uncertainty, or do you see this trend playing out in a more permanent way for the future of work and for the asset strategies of large commercial office owners?
Yeah, there's just some unassailable logic to the notion of having this third place, right? This maybe work near home solution. We hear from the market participants, the brokers in the market that we talk to, that a lot of particularly the large occupiers, are asking for some sort of flexible solution as part of their lease deals. I heard more of that a year or so ago than I'm hearing right now, but I'm sure that's still happening. And then, of course, you've got WeWork, which is, I think because of its own challenges and their business model, they've scared off a lot of possible would-be partners for work. Including lenders, including maybe landlords who might be willing to, give it a go themselves. It's a dynamic segment, and I think with market conditions the way they are, with so much available space, I think there is and is going to be a lot of experimentation. I know that some of WeWork's competitors, for example, were eyeing some of their spaces when right around the time of their bankruptcy filing, saying, I like that one, I like that one, I don't like that one, I don't like that one. I know that some landlords were thinking about, okay, well, we've got 40% exposure to WeWork in this one building, so maybe we can take these couple floors and turn them into spec suites. Maybe we can put a WeWork competitor in another section of it. I mean, so they're proactively thinking about that sort of thing. And I mean, these are things that Jamie Hodari has said publicly, CEO of Industrious. So certainly that kind of thing is going on, and it makes sense to me that this idea of I've got a downtown office and then I have a flex workspace I can get to that's maybe in a first or second ring suburb when I need a place to get away. That just makes so much sense, but I don't know that it's a sea change trend, at least that we're seeing, at least not yet. You're probably closer to that than we are, frankly. So
maybe a quick follow-up on that, Phil. Sort of in the context of complications, for that landlord that perhaps does believe what you were just laying out, that sort of that obvious fact, and for that landlord or that portfolio owner that decides they want to create flex inventory, whether that's partnering with a Serendipity Labs or an Industrious or building their own, they're facing some complications. The current elevated interest rates and the construction costs and the depleted capital stores of many owners kind of runs smack headlong into the unavoidable capital investment needed to build out spec suites or to do that build out to launch a co-working space. How will the availability of capital to owners interplay with the potential or the growing demand seen in the market for flex?
Great question.
Yeah. Well, I mean, I think you really put your finger on something, right? Because a lot of the the challenge here is about underwriting that.
Yeah.
And so if you think of it, like the simplest way to do this is, I am an all equity owner and I'm going to hold this building forever.
Mhm.
And as I am experimenting with how to maximize the return on my asset, I've got some available space. I'm going to, put some money into it to develop the physical features, the amenities, the technology package, right, that makes that work. So that's where I think we probably already are, and we'll see more experimentation. On the other hand, for a lot of owners that maybe they just, in 2017, it's like, oh, this is great. WeWork's going to take half our building. That's a little bit different situation. And I think convincing capital sources, even in an environment when hopefully we'll see lower rates and more stability, I think that's still going to be pretty difficult. Just until there are more proven use cases. Again, like I don't have a stance on whether it should be more difficult or not, but I think what's happened with the big brand in that particular space, and kind of the taint that it has now, is going to be difficult to work through the more different players you have involved in any one situation.
Fran?
Yeah, Phil, just to follow up on this financing issue, you mentioned earlier that you see inducements. The rates are staying pretty much the same, the actual rental rates, but the inducements are going up, in some cases materially, which would require capital to do that. Where are these landlords coming up with the money to do that?
Yeah, so this is my second hot take, which is I think this is coming to an end. I've described this as couponing, right? Like you go to the grocery store and the ham still costs $17, but you have a $5 coupon or whatever. That's a terrible analogy, but anyway, I think it'll at least make sense. I think it is coming to an end for exactly the reason that you state, is that if you're offering a TI allowance, well, somebody's got to finance that construction. If it's not the tenant, it's going to be you as the owner. You're not going to come out cash for that traditionally. So I think both the costs to pay for the construction itself, because of just general inflationary pressures, particularly in the service sector, but then also the financing costs, the carrying costs of that, have risen. And then on top of that, especially if you're looking at like a refinance event or a loan maturity event, where your rate's going to go from 3 to 7 or something ridiculous like that, then it's going to be really, really hard to keep doing that, to keep eating into the value of your leases, essentially subtracting from your NOI, while at the same time your requirements to cover your debt service are going up. Yeah. At least in a cash basis, if not in a ratio basis. It's just going to be harder to do that. So I think that, plus all that available sublease space that tenants have largely avoided to this point, because I think a lot of that is because they don't actually get that build out, that custom build out, but it's that space is still out there. And then I think you have these new lower basis owners coming in, who don't have all that pressure to cover debt service. Even if they have a loan, it's a lower amount because they paid less for the building, right? So I think the combination of those factors means that we are going to see face rents start falling, until, and it'll be interesting because I'm actually really excited to kind of watch this play out, because we've got those pressures in the short term, but we also have no new supply, very little new supply. And so by the time we get to 26, 27, new supply is going to be like its lowest share of inventory on record. So that would then put upward pressure on rent. So I think we're going to have this interesting case where rents sort of fall for 12 to 18 months and then start picking back up, just because it sounds a little crazy, but we're going to run out of the space, of the particular type of space that tenants still are demanding, which is that new inventory. We're going to run out of that in a couple of years.
Is there a market in Vegas for this? Is there an app you can get to spot on radio. I mean,
I am a market
bet
analyst.
on
I
this.
do
If
not
you
give
bet on this,
investment
everybody would-
advice. So
they'd be more excited about this whole process if you could make money on the bet. Just a sort of a related follow-up to the flexible space. The term we hear a lot in the workplace community, at least, is space as a service. And I think there's an awful lot of this, I think, in EMEA, UK primarily, but it's starting to creep in here as well, where basically the tenant gets all the amenities and specific amenities that they want. They pay for them, but they have exactly the kind of environment that they need for their space. Do you see this moving the needle at all? And does it come out in your data in any way that we can measure?
yeah, so I think one way that comes out is in that preference or relative preference for new space. Although, I think that's at least as much about new space is always popular, and what's happening now is that the old space is very unpopular. So I think that's part of it as well. I've been having conversations with some of our local market analysts. We have a team that covers most of the major markets around the country. And they've been telling me about whole building availabilities, right? And how tenants are giving those a strong look for precisely that reason, that they can turn that into their own workplace that is built specifically for them. And even if it doesn't have some of maybe the location oriented amenities, they can put in place what they need there. So I think that is a trend. That there are so many of these 100 to 200,000 square foot buildings that are essentially entirely available, and so it is creating opportunities for some companies.
Great, thank you.
So you mentioned before about how some companies are doing all cash deals. I would imagine they're very large and they're sitting on a mountain of cash, especially if they're publicly traded. If you're small and bootstrapping, your acquisition of space is going to be informed by the fact that you probably don't have any funds to spend, and you're probably working from a home office or from some cobbled together deal, so to speak. My question, Phil, is do you have any insight as to what happens to companies in the big great middle? Perhaps they are through C round of financing to go public. Perhaps they're growing, but because they need that cash to invest in technology, invest in intellectual property. Do you have any insight? Does CoStar have any insight as to what happens to companies like that when they look at their leasing needs?
So here I think is something really interesting to think about. So as a thought experiment, go back in time 7 years and think about those big tech companies that were leasing extra space.
Right.
And think about what they were doing with the space they weren't using. Well, they were probably putting it out for sublease, depending on how long it was available or how long they thought until they would need it. So now think about who was the market for that sublease inventory. It's exactly the type of company that you just described. And so now I think for a variety of reasons, one is in these sort of like early, not very early stage, but sort of mid-early stage companies. They competed like heck for talent. And one of the ways they did that was by offering flexibility. Their investors and their capital sources have either dried up or have gotten more expensive. So they're not as easily able to access the kind of capital to go lease a big office. So they're having to tighten their purse strings, which is keeping them out of that sublease space, right? So I think that, their focus is more on running their businesses on talent maintenance. And it's, I'm sort of triangulating this, but it makes sense. And it lines up nicely with, well, how come a lot of this really nice Class A sublease space is still available and has been sitting there for a while? And I think that's the answer, is because a lot of on the demand side, a lot of the companies that heretofore would have taken that space are just focused elsewhere.
Good point.
Gentlemen, Phil in particular, this has been a absolutely fabulous conversation, and I hope we can get you back because this was an information-rich live show. I'm going to watch it again and again and again. I learned a lot, and I cannot thank you enough. Before we get to our final question to you, I'm wondering if you could point our viewers and listeners to you on social media, where they can find you, and perhaps where they can even connect up with you.
Sure. I'm on LinkedIn. I think it's Phil-Mobley now. My email address is pmobley@costar.com. Every now and then I still do tweet or post or whatever it's called now, and that's at Philarius Rex.
Oh my goodness. Okay. Well, we're at the end here, and this is the question we ask all of our guests, and it is, what is your work fit? What's your work fit? What attribute, condition, experience, place, or state of mind makes work a wonderful part of your day, Phil, doing many wonderful and meaningful things, and not the all-consuming time suck of a day? What's your work fit?
Yeah, sure. So I think I am blessed in many ways to be very well supported for the work I need to do, both at my office, which is where I am now, and at my home, which is where I am once a week. I have private space that is tech enabled and lets me do what I need to do. You can see some of my kids' art on the wall behind me. So I'm really happy with kind of the setup. I think another key to this is, again, it's a blessing to me to have a long but a low stress commute. So I have about an hour train ride on a commuter rail line. I am not white knuckling through traffic. I am not standing on a crowded subway. I get a seat. And so that time is redeemable, and that it makes all the difference to how I work and to how I live. So in the morning, I'm a practicing Christian, and I need a lot of practice. And so I have a routine where I'll read some scripture and I'll pray, and then I will maybe listen to a podcast, sports, history, whatever. And then maybe in the afternoon, I might finish that podcast and I might read a book. I'm reading a book right now on the history of the U.S. involvement in the Middle East, right? Some people, that sounds terrible, but to me, that's really interesting.
That's
so
easy. That's easy reading.
That redeemable time and the discipline involved in maintaining that schedule, I think and hope it enables me to be both a better worker and then better also when I'm outside of working hours.
Before we depart, I just want to say that the slide deck that Phil took us through will be available in the show notes, the comment section on this post on LinkedIn. I'll try to do it as well on our YouTube page. And Phil Mobley, I want to thank you for a truly inspiring, informative session today. And again, we'd love to get you back. Let's continue this as you develop new insights on the marketplace. Thank you for being on.
Absolutely.
Thank you for being on the Live Show.
It's been a pleasure, Dan, Fran, Mark. Thanks a lot. I appreciate it.
Thank you, Phil. Great show.